Yes, regarding AI lectures, we're putting AI lectures in the Stocks and Psych group and the Zero to Millionaire group, and you still actually have a few hours left before we start changing the pricing, mostly because I'm still recording lectures and I just haven't gotten to it yet. So it's my fault, but I'm working on it. Let's get into the video. Hey everyone, me Kevin here. In this video, I'd like to talk about an opportunity ahead of us, specifically with regards to inflation and what that could do to the stock market. Yeah, and that, in order to suggest there's an opportunity, means there might be a negative catalyst ahead of us, and I think there actually might be. And I'd like to talk about that so that when and if it occurs, we're prepared in America and people don't freak out, although there is a chance people will freak out. I do think there's a chance there could be a short-term buying opportunity coming up if what we're seeing in Europe ends up happening in the United States. Now, no guarantees that this is going to happen, but let's make this very clear. Obviously, the banking crisis did not tighten credit conditions more than were somewhat expecting them to be tightened by. In other words, credit conditions were already tightening going into the banking crisis. And coming out of the banking crisis, credit conditions have continued to tighten at roughly the same level, which means the banking crisis was really an edge case scenario of banks, yes, on a nominal value greater in size than what we had during 2008, but then again, we have a lot more money in circulation today, hence inflation. But really, in terms of a systemic crisis and a lack of credit availability, haven't quite seen that yet. We've seen continued tightening on broad credit availability for subprime loans, but that's been happening going into a tighter economy. That's the first thing to tighten, so that's not a surprise. The problem with that, though, is it gives the Federal Reserve more ammunition to say, okay, well, then we'll just keep hiking rates, because if credit conditions aren't going to tighten the economy, then we will, by raising rates, which is another way of tightening credit conditions. All of that to say is, with that and anchored inflation expectations, but not low inflation expectations, the Fed's going to have a license to do more. But the near-term catalyst that I really think everybody should pay attention to is the following. This. Yeah, this is a ripped section of the Financial Times. This is a newspaper. Somebody comes by at 5 in the morning and throws it in front of my house. And then I read it. The beautiful thing about it is, it's a day late. But that's okay. But what it reiterated was something a lot of us missed in the news, and this is actually why I personally like the newspaper. People are like, Kevin, why do you bother with the newspaper? Like, that's stupid. I'm like, no, it's actually not, because it doesn't change, unlike the front of the New York Times or the Wall Street Journal or whatever online, which changes every like 5 freaking minutes. This doesn't change. So you get a snapshot of everything you missed, all the good research you missed the day before in the paper form. Anyway, remember how, and we're going to talk about this because it's important, it's going to set up the catalyst here. Remember how the United Kingdom saw this happening? This is the really concerning jump in core inflation. We've talked about this like 20 times before, so I'm not trying to regurgitate the same crap here. What I am trying to suggest is this de-anchoring of core inflation is a problem. But look what just happened in the Eurozone broadly. I'll let you read the title here if the camera is so inclined to focus on you. Eurozone core inflation, rise, tests European Central Bank. Fantastic. Rebound in key consumer figure increases chance of higher rates. Eurozone inflation fell more than expected to 5.5% on the headline in June, its lowest rate since the start of last year. But, excuse me, any relief for policymakers was tempered by a slight rebound in core consumer price growth. Core inflation, which excludes the more volatile energy and food categories, was 5.4%, up from 5.3% year over year in May. And this increases the chance of maybe seeing more hiking from the central banks. Okay, this is understandable and to some extent reasonable. We would expect that. However, what does this potentially mean for America? Now that you've got the United Kingdom seeing core rise more than expected, although much worse than what we saw here. I mean, this was a 1/10 of a basis point. It's not that big of a deal. But what does it potentially say to America? Well, to understand that, we have to first try, and this is not a science, we're just trying to do our best, try to understand why core inflation is de-anchoring in European regions. And personally, Lauren and I were considering traveling to Europe, but one of the reasons we actually decided probably not to this year is the following. Take a look at this. Going to Europe this summer? You're not alone. After 3 years of pandemic restrictions, travelers are flocking to Europe in record numbers, despite high airfares, limited accommodations, and crowded sites. Here's what you might encounter. And basically they talk about how even though Europe in the summer is always like sweaty and crowded, this is probably going to be an exceptionally sweaty and crowded summer. I'm oversimplifying the article, but whatever. It's the Times and we're not going to spend too much time on it. Although I know a lot of people give the Times crap. They do have pretty decent stuff. So that led me to think, okay, well, if Europe is blowing up with travel and people are paying for travel no matter what, and travel is one of the biggest parts of, guess what, core inflation, then who's tracking just core inflation? Can I get a little bit of insight into just core inflation and these categories? And so NerdWallet actually has what they called a travel inflation report. And I found this very interesting. I'm just going to slide to the part where it matters. Look at this. Change in travel prices, and this compares travel prices back to the pandemic. And you really have to draw a line right about here at the 0% marker, and obviously everything's up. You could see that flights are only up about 10% last month, 5% this month. So prices for airlines are starting to decelerate. But what you're finding is food away from home staying strong at about 25% more expensive than before the pandemic. Hotels at about 15 to 19% more expensive than before the pandemic, and car rentals up nearly 50%. And if we compare that to the past year, we could see airfares are down about 13%, but hotels still up 3.4% compared to last year. You've got car rental prices down 12.4% from last year, but still way up from the pandemic as we saw. And food away from home prices up 8.3%, as well as movie theaters, concerts, and entertainment up 6.6%. So what you're finding, where's hotels here? Hotels and motels, yeah, up 3.7%. So outside airfares, everything else, airfares and car rentals, everything else is pushing up that core, at least according to NerdWallet. So then I thought, okay, well, let me go see if that's corroborated, at least to some extent. Are we starting to see some of those signs in the CPI data that we last got? Obviously, we've got a new CPI data set coming out soon. But what do we have over here? This is the last CPI data released from about 2 weeks ago. Next one comes out again in about 2 weeks. Duh, we're at the midpoint. Airfares slowly starting to decline. That's great. But how are other services going? Well, transportation services, right here, leased car rentals are down, which reiterates what the NerdWallet site indicated here. But in terms of motor vehicle maintenance and repair, motor vehicle insurance, parking fees, public transportation. Let me actually see if I can pull that. Yeah, public transportation way up, which is much more common in Europe. I understand this is American CPI, right? But there are some similarities. Much more common in Europe to see this public transportation. Transportation services over here up 0.8%. So potentially some similarity. Where else can we see some similarities? Well, alcoholic beverages, you're seeing a rise in CPI here. You're seeing a rise in alcohol away from home at 0.7. And I understand the weight of alcohol away from home is really just under 1% of CPI, but still, it's a contributor, along with all of these other aspects. Transportation services makes up almost 6% of CPI. It's actually a big deal. Public transportation being part of that. Airfares, again, we know is going down, but there it is. Intercity transportation, up. Shift fare, up. You're seeing more of these prices going up as well for cruise liners as well. What else is going up? Well, of course, your miscellaneous personal services, whether those are legal, funeral, or otherwise expenses. But I'm specifically looking for travel items right here. So we're going to look for maybe food away from home and see where that is calculated. Food away, and then we want to look at lodging. So food away from home index rose 0.5%. And then what about lodging? Let's pull lodging in here. So lodging away from home, here we go. Lodging away from home. Look at that large bump here, 1.8%. And this is going to be, look at this, other lodging away from home, including hotels and motels, 2.1% as we're going into the summer months. So I think what's potentially happening, and I'm going to try to bottom line this here, and then let's talk implications. I think what's really happening is the following, and I can't know for sure, but let me put it this way. Individuals' excess savings in the upper 60% of income is still vastly positive. The bottom This is going to be the bottom 40%. The bottom two quintiles, they call them, are negative compared to the savings that they had pre-pandemic. And I always like to write in red so it contrasts from like reports we're reading and stuff. But anyway, individuals' excess savings in the upper 60% are still vastly positive. Thousands of dollars positive. We're talking to the tune of probably $3,000 to $5,000. Still positive, if not more. So I'll put K plus. Again, bottom two quintiles negative. Okay, so these folks prob not going to travel. But who's going to travel anyway to Europe? Prob these folks going to Europe, all right? So now what we're doing is we're actually taking the excess savings and we're actually taking that and contributing to core inflation because the economy for a normal American isn't actually that bad. As a result, we're contributing to core inflation around the world and in America. Because you're not just going to obviously travel in Europe. You're going to go to Vegas. You're going to go to Texas. You're going to go to the Florida beaches. You're going to go to New York, with the exception of all the smoking crap they have over there. You're going to travel again. And this makes sense in an element of, like, if we're in 2030 and we're looking back and somebody told you that, we printed a ton of money and then we had a lot of goods inflation, people would be like, yeah, that makes sense. You guys printed a lot of money. And then that goods inflation went negative. People were like, yeah, that makes sense. People bought all the stuff they need. They got their new gaming computers. They got their new Lululemon pants or whatever. They got their, Meet Kevin short shorts. Dude, I love these things. They're like $18. Anyway, so then what happens? If we're in 2030 and somebody's like, okay, cool. So what happened after that? As if you're telling the story of living through 2023 and somebody's like, so what happened then? And then you're like, well, after the pandemic, people were still somewhat afraid to travel, but then all of a sudden, people who hadn't spent all their money on goods or were still making money at jobs because jobs were readily available, even if they lost their job, they got another job and maybe even got paid more or at least the same. What ended up happening? Well, then they decided they wanted to live a little, so they went traveling, especially to Europe, because they haven't been there for a while, especially since Europe had COVID restrictions a lot longer than America did. So what ended up happening? Oh, well, we got this boom in travel inflation afterwards. And then that ended up normalizing after people spent the rest of their money. By the way, we would probably be like right here. There'll be some normalization of actually goods inflation that you're going to see. And so we're probably somewhere, right there at that messy kind of line where we're still in the summer period where we're going to see probably a boost in core inflation because of travel. And so I think this sounds reasonable. If you're at 2030 looking back, you'd be like, yeah, that makes sense why you had goods inflation. Now that makes sense why you had travel inflation. So what does this mean to you? Well, what it means to you is there could be a near-term problem in the next few inflation reports. So if I had a crystal ball, I'd probably say June should be mostly okay because of the year-over-year comps for the year-over-year numbers. However, that core, which is expected to be 0.3%, could miss. However, where the most likely miss will occur, and this is what I think is really important, I think it's most likely we'll have a miss for July and August. And then at September, you'd probably have some kind of plummet in core inflation. So I would expect in core month over month. So high core month over month, and over here I'd say high core month over month. Now, what is the CPI schedule of releases? And what are these dates that we have to pay attention to? Well, we know this one here is July 12th. We know that these next reports come out on August 10th. That's Lauren's birthday, Aug 10. And then September, Sep 13. And then you're going to have a few Fed meetings over here. The July Fed meeting, probably more benign. This will be a little bit scary, probably. And then Oct 12. So this is where maybe you see the plummet. So frankly, what does that mean? That means some volatility could be high. That is high likelihood of potential stock pain as people think inflation is de-anchoring again between August 10th to really about 12th. This would be maybe your hedge period. Something to consider. It could also be by the dip, whatever. But if I was looking for a potential catalyst coming up, it'd probably be in this range. And it's all based on that sort of core inflation that I think might explode. So hopefully that's insightful and useful to you. And I wish you the best of luck, and I will be here with you either way with whatever happens. Thank you, by the way, to StreamYard for always helping me a live stream. Go to metkevin.com/StreamYard to learn more about how easy they make this with software that you could run through Google Chrome. It's really incredible. Super powerful as well. Paid sponsorship. Check it out. Link down below. Thanks so much. Goodbye.
Now, I want you to know this. When it comes to AI, time is what's going to make you money. And if you can prove that value to an employer, you'll always be able to be employed. So this is another way of making sure that you don't get replaced by